Hey everyone, welcome back to Accounting Basics. Today we're diving into one of the most essential financial statements in business, the cash flow statement. A cash flow statement shows how cash enters and leaves a business during a specific period, usually monthly, quarterly, or annually. It tracks the actual movement of cash, unlike the income statement, which is based on accrual accounting and includes non-cash items. In short, the cash flow statement answers one big question. Is the business actually generating cash, and where is it going? This is crucial because a company can be profitable on paper but still go out of business if it runs out of cash. The statement is divided into three main sections. 1. Operating activities. 2. Investing activities. And 3. Financing activities. First up, operating activities. This section shows cash generated or used by a company's core business operations, the stuff it does to make money. This includes cash received from customers, payments to suppliers, wages and salaries, and taxes paid. If this section is consistently positive, that's a good sign. It means that the business is generating enough cash from its day-to-day operations to sustain itself. Next, we have investing activities. This section covers the purchase and sale of long-term assets and investments, such as buying or selling property or equipment, investing in other companies, and selling off investment assets. Generally, a negative number here isn't bad. It often means that the company is investing in its future, but too much outflow without results can be risky. Lastly, financing activities. This includes cash coming in or going out due to borrowing or repaying debt, issuing or buying back shares, and paying dividends. Examples of this include taking out a loan, which would be cash in, repaying a loan, cash out, issuing shares, cash in, and paying dividends, cash out. This section tells you how the company funds its activities, through debt, equity, or paying back investors. When you total all three sections, you get the net change in cash for that period. Add that to the beginning cash balance, and you get the ending cash balance, which is how much cash the business actually has. Here are the three takeaways. 1. The cash flow statement shows actual cash, not just accounting profits. 2. A positive cash flow from operating activities is a strong sign of health. And 3. Always look at how investing and financing cash flows affect overall liquidity. If you've ever heard the phrase, cash is king, this is why. Now you know how to read a cash flow statement and understand the story behind the numbers. If you found this helpful, give it a thumbs up, subscribe, and let me know in the comments what accounting topic you'd like to learn next. See you in the next video.